Welcome to this week's Escape Your Limits podcast, live from the Connected Health and Fitness Summit in Los Angeles. This episode was pretty fascinating with Jon Canarick.
From Northcastle Partners, so they are very much in the purpose-driven, healthy living lifestyle brands. They have a range of people in their portfolio, or brands in their portfolio, Barry's, they do Echelon, they do Genexa, they have a lot of great brands, so fascinating sessions.
Great question, first one that you asked there, Emma.
Great question, so are we in a recession? You've got to watch the episode to get the answer, it's not what you expect.
I also found it very selfishly, I was really curious in terms of what are they investing, how their investment strategies changed from during the pandemic to afterwards, and there was quite some significant changes in terms of the companies that they looked for and what they wanted in terms of a company that they were going to invest in, so I found that fascinating. Anything else?
No, I just think really important to watch this episode because a lot has changed in the fundraising space. We've had lots of sessions throughout the summit, lots of investors here. Also, they participated in the Innovation Showcase and they were judging ideas, so we were getting this real life spin on what they truly look for today. It's not just a great idea, it's much more than that. Get the clues in the episode.
Please enjoy this week's episode of the Escape Your Limits podcast.
Alrighty, well, we've got money royalty in the house. We do love to chat with this one, Jon Canarick from Northcastle Partners in New York City.
Yes.
Now, you have a very exciting category, quite broad, so everything from healthy, active, sustainable lifestyle businesses, right? So you've got everyone from Barry's, we know Barry's very well, Echelon, you've got Therabody, Genexa, so a real mix. Welcome.
Thank you.
We're very, very interested, and of course we want, first I want to start with the $3 trillion question. Are we in a recession? What's your answer to that?
We are in a products recession and not a services recession.
Great answer.
So the consumer is still displaying through their purchases that they've had enough from being at home and buying a lot of stuff. And so their reduction in discretionary dollar because of inflation and because of, stock market issues or wealth concerns is playing out in my data set much more across the product universe than the service universe. The service universe is still on the upward recovery trajectory from COVID.
That's really
Fascinating.
interesting. I would never have broken it down like that. That's a useful bit of information to know. Yeah. So what does that mean for some of the brands that you're representing? Like, I guess one of the biggest ones, success stories we've seen is Peloton.
Sure.
What's yours? How would you describe that and the ripple effect that what's happened there has had on what you do?
Yeah, I mean, the combination of Peloton and the related companies in the home fitness, category obviously had explosive growth, which has ultimately been to the detriment of their shareholder value because it was just so volatile and so difficult to manage. But what you see playing out right now with almost all of those businesses is a sharp reduction in the number of products they're selling, right? The hardware, the physical goods, and reasonably strong service revenues still. So the four-wall players, the service businesses in gym services, whether that's traditional or boutique, are all doing quite well right now relative to 2021 and even 2022. But the thing that people are not quite talking about is there are still millions and millions of workouts a month happening at home as a result of Peloton and the related companies that were not happening there before COVID. And so despite the fall of those businesses, which is mostly a hardware fall, they're still getting a lot of use.
Yeah, new behaviors, right?
The behaviors, and they're not as strong, right? People are not working out
Not that
16
either.
times a month or whatever it is. They're working out, far fewer, and they're leaving their home and they're working out in gyms too. But the sheer number of workouts happening at home remains quite elevated relative to pre-COVID.
And would you say that then that is, I guess, listening to what's happening, there would definitely be reservations about getting involved in that space at the moment.
Yeah.
But would you say that being aware of that could be an interesting time maybe to figure out how to be involved in it, even if it's on a long term play, is this still a very interesting space as opposed to bailing from it?
Look, in the world of buy low, sell high, this is certainly a good time to be looking into that industry. You have to be able to see, beyond the next 12 or maybe even 18, months. The number of pieces of hardware in the home that we, as consumers, acquired, digested, whatever term we want to use, was an extraordinary amount. And so you clearly pulled forward demand, but at the same time, I absolutely believe that those businesses all have a very good long-term trajectory. Peloton, our business Echelon, and others. And I think it's as simple as the home fitness industry existed before Peloton.
Right.
Peloton so brilliantly put together content and hardware and brought it, to the masses under an enormous capital raise and therefore advertising, budget. But people were buying DVDs before. They were buying home bikes and home treadmills and lesser extent rowers. And they were buying, Beachbody DVDs or Zumba DVDs. So they were buying their content, or P90X or whatever, and they were buying their hardware, and Peloton brought those two things, together. And so I just think long term, connected fitness, like a lot of other 2.0 or 3.0 categories, take share from non-connected fitness, just like we buy other smart categories today versus the predecessors of unconnected categories. And so I do think very much so there's a long-term play there where hardware volumes normalize and they begin to grow again because they take share from the stuff that's been there forever. But Americans bought 5 million treadmills a year before COVID. And so there's a mass jump and then there's a fall because of that overconsumption. But eventually there's a return to the mean.
Yeah. I've got a feeling that more has changed. Like you'll hear a stat thrown around, we lost 30% of our doors.
Yeah.
Like we hear that.
Yeah.
I think personally there's a lot more going under the hood. Like the cohorts have changed.
Yes.
Younger people are going back to clubs, so therefore the expectations are changing.
Yes.
We're much more tech aware now. We've actually also got the generation active, I guess. We've got the millennials and the Gen Zs and the alphas coming who are their purchasing power is beginning to come in. So I think there's been a lot of change. You mentioned, while not the same numbers, there's a lot more people working out at home or at least doing it maybe once or twice a week. What other behaviours are you seeing across, I guess, the whole portfolio? Because you're seeing things broader than just fitness.
Yeah.
What other behaviours do you think are going to stick beyond COVID and certainly out of the next couple of years?
Yeah, I think our relationship to value has evolved with appropriately more scrutiny. And so I think people are not just like, oh, it's X, I'll just pay that, right? I think there's a little bit more thoughtfulness that goes in. And I think
research,
business,
or do you think people are researching, or?
Look, everything is researched, right? Whether it's researched like in a Yelp sort of way, or it's just my friends on
ChatGPT way.
ChatGPT, right? Or it's just what they see on Instagram. Reviews matter so much, right? I mean, everything is so scrutinizable, right? Because of all of the social commentary out there and reviews out there. But I do think our relationship as consumers with our choices has become maybe a little bit more intentional, more mindful perhaps, which is a good thing, right? I mean, a flight to quality is a good thing. If you're going to spend, $199 a month on a boutique fitness membership or $30 a class, like it should be a thoughtful purchase, right? You should know that you're going to get a good outcome from that. And on the flip side, the HVLPs will continue to take market share in the traditional gyms because that pricing model is just very attractive.
Yeah. When do you think that will swing back? Because sure, you're getting the numbers, and for $10 a month, 15, 20, whatever it is, fine. But are those people engaged? Some of them will be, but a lot of them won't
Sure.
be. It's a churn and burn. And also, I don't quite see it on my credit card, so I'll probably leave it on there.
Yeah.
But all models have their time. What do you think will happen in 5 or 10?
Yeah.
Because we've seen this before.
Well, it's so interesting. If you watch the pricing, Planet's obviously the biggest player in the category, and they've held that $10 a month advertising price. But that Black Card has moved up.
Right.
Quite a bit. And
Right.
so it's getting closer to what we used to call that kind of middle
The
price
mid-market.
tier. It's
Right.
getting a lot closer, and now Planet has no frills,
Right.
right? There's no group fitness.
No group
Is basically the main thing I mean by that. And so the price point in the category that some people call HVLP 2.0, right, which there's many participants in, including Crunch Fitness, which is a part of my portfolio in disclosure. We're a franchisee, but there's lots of regional HVLP 2.0 corporate-owned stores. And the price point for the tier that includes group fitness is creeping up. Now, it's still not $40 a month or $50 a month. It's still not at that older LA or 24-hour pricing, but it does cost something to provide those services,
Yes.
right?
Yeah.
And Planet Fitness, I think, has really brilliantly brought up that average revenue per member or dues per member by tweaking that Black Card pricing very successfully.
Introducing the next big thing in functional training, the Escape Barrow, a revolutionary training tool that combines a loaded farmer's carry with a sled push to develop hip, grip, and core strength. Developed in partnership with Pete Holman, inventor of the TRX Rip Trainer and Nautilus Glute Drive, the Escape Barrow can be rolled, pushed, dragged, and carried. The Escape Barrow packs a punch with an impressive load capacity of 440 pounds, and with a 2-stage galvanized paint covering process, it's also ideal for outdoor use. So head over to escapefitness.com/barrow. That's escapefitness.com/barrow to find out more. Enjoy the rest of this episode.
To your earlier
Yeah,
point,
yeah.
intentionally, I choose that value, therefore I value it,
Yes.
rather than I had to pay that price and now look at all the things I'm not getting.
Exactly. If I'm going to be a very occasional user, I'll just pay the 10, and that is really low.
Really low.
We could all make our cups of coffee reference of what that is. It's really low, right? And
It's one hotel coffee.
it's one hotel
just a London
We
coffee.
just found out.
Is that right? Oh my goodness. And so you're right. If you choose the Black Card pricing or the premium tier at one of the other HVLP companies, it is a very intentional thought, and you could always drop back down.
Yeah, exactly.
What are you seeing in the equipment space on the commercial side? Have you got any observations about what's going on there?
This sounds like a self-serving
It
question.
is.
Well,
Very much is.
I don't have a lot of observation because I'm not directly invested in it. We are an investor in Hydro Massage, which is not a fitness equipment company. It's a recovery or relaxation equipment.
Do you see, because
we-
with what's happening in consumer and even with your Echelon,
Yeah.
are you seeing that move out into some of the commercial
Yes, for sure.
verticals, for example?
Yes, and part of that is when we came into Echelon, our business plan was probably 80-20 residential to commercial, maybe 70-30 over time. Obviously, COVID completely tore that down and became 100% zero, and now there is a concentrated effort to go back to that 80-20 or even 70-30 model, in part because this market's recovering and this market has had too much, as we talked about before. So I do see a big role for connected cardio. I don't know that I see an obvious role for connected strength in traditional fitness. And I will say this, some of our HVLP clubs have gotten so busy in Crunch that we've started actually putting more equipment in. And I think there was a trend for a while to take equipment out and create more
turf,
functional
some
space and
yeah.
turf. And that still is important. People do still want to work out that way, particularly people with personal trainers, and we have a strong personal training business there. But we certainly watch our floor, and we don't want to see long queues, right? And so it's a balancing act. We are actually sort of net adding right now on a per store basis.
So when you're looking, there's a bunch of people here we've interviewed, and you're on the panel tomorrow where people with ideas are coming to companies like yourself
Yeah.
to try and raise money. How has that changed in terms of when you're sitting around the boardroom in your organization? What are you now thinking about in terms of, well, this is worthwhile and interesting in us investing in, and these are the things that may used to work, but we want to get out of it now?
Yeah. So first off, I think one of the things that has changed, kind of on a more macro level, is venture capitalists got heavy into consumer categories, which were traditionally technology, media, or healthcare focused, right? That's where the bulk of the venture capital dollars have gone over time. And they've really, in the last few years, where valuations and were so high and losses were so high, venture capital came into categories that they weren't in traditionally in the pursuit of, buying customers, right? For funding media and funding other technology and content investments. And I think venture capital is backing way out of those categories now, because the big difference, not just in an addressable market like healthcare, which is this enormous market, is when you sell a physical product, you have a cost of goods sold. And there's just been this tremendous overestimation on lifetime value, which is a revenue kind of term. And really, the value should stand for profits, lifetime profits. But most people actually are talking about lifetime revenue and not lifetime value. And so there has been a swing back it happened rather quickly, right? But a massive swing back into scrutiny over business model, and does it serve a large enough audience? Does it have a real path to profitability without burning tens or hundreds of millions of dollars? It doesn't mean businesses can't burn capital in the early days. It doesn't even mean they can't burn a lot of capital if their addressable market is large enough and their path to profitability after heavy scrutiny holds up. But that scrutiny has really changed in the last
way
6
would you
months.
say?
It just needs to be a lot more believable.
And how do you do that? Because we've established business, been going for a long time, and there's a lot of companies that have just come up with great ideas. Seems like a good idea, and even someone that's been involved in product for 25 years, I wouldn't know how to create a projection for the next 4 or 5 years. It's all guesswork, is my mind.
It's all guesswork.
So how do you come up with something and almost make it believable when it's totally, unless you've got a good pair of crystal balls?
No, well, look, there's a, sort of people use the term unit economics, and that's an easy term in a store business or a four-wall business, but every customer in a non-four-wall business, essentially has a unit economics. It's going to cost me this many dollars in advertising to acquire that customer. I'm going to make this many dollars on their first purchase, and I can believably expect them to pay me more over time in the event we're talking about a subscription business or some other type of business where repeat purchase is a meaningful part of the equation. It's just the level of scrutiny against that, where we let ourselves very foolishly as an investment industry buy off on multiples of revenue as valuations. And it doesn't make any sense, right? I mean, it makes no sense. And
you're the smart guys.
Right. Well, I didn't do it, but other people. No, I mean, it really, again, that's why I started with venture capital, because that is a more typical venture capital mentality. And when venture came in, it funded a lot of these initiatives, right? A lot of the backers of some of the businesses in fitness, but this goes way beyond fitness, right? This goes into all sorts of categories, all sorts of companies that burn enormous amounts of money, which doesn't mean there's not a place for it, right? Doesn't mean that, I'll use Aura and Whoop as examples. I don't know anything about their P&Ls. They all may be very profitable today, I don't know. But if they're not, that sort of heavy investment in technology to get to the promised land may still be highly justifiable, right? That may still make sense. I don't know, I'm not involved. But it may make sense on the beliefs that a higher and higher percentage of the population is going to want to track and measure.
Is that what you call the serviceable market then? So you look at, how many people would wear a ring, and then you break the numbers down from that.
And on the fitness side, I get pitched all the time, even though I'm not in venture capital, by people who are looking for funding for their new fitness equipment business or the like. And 9 out of 10 times, they're proposing something that is very niche. And it may be the greatest concept in the world for a very small number of people. But there needs to be a realism, whether it's achieved through research, right? Go talk to 100 random people, show them your product. How many of them are interested in it? In a real way, not in a way that's making you feel good, because
it's great.
they want to go on their way on the street, right? But real research, you could do real research, right? And so trying to figure out that addressable market is a big part of it. And then the unit economics, is it if I sell it for $100, do I make $60 after marketing expenses and product costs, or do I make 10? Right? Like, those are
Different scenario.
very different. And a lot of people think that solves itself through scale, and that's an enormous fallacy.
So just to summarize then, if you do have an item you're looking to raise money, then really get clear on the potential of that addressable market, and I guess how many people are also going after that same market.
Yeah.
And then really having a good pathway to profit that can be scrutinized. And then when you've got that together, then you've got the ability to sort of make a good case to raise some money, whether it's for the right size firm, for example.
You have to find the right size firm, the right size investor base. I also think we're going to swing back to the days where I don't know enough about your beginnings, but did you go venture capital, or did you just figure it out?
We were like bootstrap.
Yeah.
And that's where when I've come to America, it seems like maybe in England that's just how you did things, but when I come here, it's like everyone, you get an idea and you go out and you raise some money, and then you go and raise some more money, and it's
right.
like, at what point do you have to make profit? Because when you do a business yourself, like from day one, if you're not making profit, you're not in business. And it seems as though in some cases, well, don't worry about that. Just get it to scale,
Right.
and then.
So I would say this, I don't think that's a UK-US thing. 10 years ago, that's how it was everywhere.
It's done, yeah.
Right, and it's just evolved. And look, the need for capital has changed because there's a base level of technology that a lot of people need, and whether it's just website and web stores, which obviously is relatively simple now, but like that is different than if you started a business 20 years ago.
Absolutely. Yeah.
People are like, oh, it's so much easier to, I could just sell it on my own website now. And it's like, actually, it was easier if you got it into Target, right? That was easier.
It's got a lot of eyeballs.
The eyeballs were natural, right? Yeah. And so I do believe, and one of the things I tell most people who ask me about funding at the venture side or the startup side is like, you need to do friends and family and bootstrap. And people are like, well, I don't have any friends and family with wealth. I have
That's your first problem.
I have all of the empathy in the world, right? Not everybody has the same network, but you are not institutional capital ready yet.
Right.
That makes sense?
Yeah.
And I think the pendulum's coming all the way back.
And do you think that's because of the cost of money as well as like?
For sure.
Yeah.
The interest rates, 10 years of very low cost money is a big contributor to this problem. The search for yield, where it made sense. I make 10 bets. If one pays off and I make 10% of my overall portfolio, it's better than 1%. Right? So yeah, I do think the cost of money is a big part of it.
Great. So given just this conversation so far, you're one of 6 judges tomorrow.
Yeah.
There are 8 already vetted, fantastic concepts. I had a quick look through them on the way here. Given this conversation, what will you be looking for tomorrow? Because I think there'll be some software plays, there'll be some experiment. I presume you've been through the deck and you know what you're judging. Like,
Totally.
What are you looking for?
Yeah, I'm looking for businesses that, I think have a realistic, long-term, profitable model, and not ones that are being built to sell. Building to sell is a very dangerous phenomenon where you are living and dying on that, whether that happens or not.
Right.
And the buyer universe for any given company, they may or may not be in a position, they may not like you, they may not like your product, they may not like your brand. And things that ultimately sell for really good prices are businesses that don't need to sell.
Right.
More often than
actually
not.
valuable.
Yeah, more often than not. Obviously, there's great technology out there. And so I'm not a software person, right? So this doesn't apply necessarily to software. I'm talking about branded consumer, which is what I spend my time, where I spend my time. So a little bit harder to say on the pure technology or software side. But something needs a realistic profit model. That's what I'm looking for tomorrow as the pendulum has swung.
Is that do you look at that outside of the idea, the uniqueness of it? Like for example, what attracted you to like the Echelon product? Was that because you saw what happened with Peloton, or was there something else that kind of...
Yeah, so I started talking to Lou Lentine, the founder, in the fourth quarter of 2018. Right, so no such thing as COVID, and relatively small business, and he evolved Echelon off of a different low-cost home bike business that he had, called Fit Nation, which is still part of our portfolio today, mostly a QVC, HSN sale kind of product. And Lou is the kind of entrepreneur who does things profitably. And so what I liked about Lou and what I liked about the company when I first met them and into the first quarter of doing due diligence, it was, we are only going to spend X on marketing that makes sense to the point of where the sale is profitable. And it's not about being profitable on the 12th month, it's about being profitable on the first month. Now, we fell into the same trap as everybody else during COVID. The demand was 5x higher, and you needed to build infrastructure, and the competition came in, and the worst thing that happened to the connected fitness industry is the dollars came in. The capital providers came in. And that leads to a race, a technology race, a content race, a customer acquisition race. And we did raise more money. The content investments we needed, the technology investments, the infrastructure to meet 5x demand, is pretty intense, right? And so that volatility at the end of the day was not good for Echelon, was not good for Peloton, was not good for iFit, not good for Hydro, et cetera. I can go on and on. Every single one. Nobody managed it well in hindsight, right? And so when nobody manages it well in hindsight, I think it's okay to say the environment was really tricky. It really was tricky. So, but going back to your question, what brought me to the meeting in the first place was I always felt like Peloton was a great product. I was a very early consumer myself. I was in the single-digit thousands in terms of my customer number, right? In terms of how early I bought that product, because I really loved the idea of it. But I really was attracted because Echelon had a much lower cost business model. And I always felt like connected fitness is great, but it should be great for a larger audience, right? Not a $2,000 audience, but can it be great for a $1,000 audience or an $800 audience? And that's what Echelon had at the time. And then the other thing is Lou and I had alignment on the business model, which was a combination of direct to consumer, of course, like we're happy to ship you a bike, but we were always in pursuit of retail relationships. And so when I came in, it was already in a couple hundred stores. Today we're in thousands of retail stores. And so the D2C spending at Echelon never was that high. We gave up gross margin dollars to Walmart and Costco and Target, but we're there, right? We're there. And so it was a very different business model than Peloton, both in terms of price and therefore the brand and the brand perception, as well as the go-to-market strategy.
So apart from being a mere mortal, I guess, and falling into that trap, what else surprised you through COVID and out the back? Like from everything like did you get any other lessons, good or bad, from the times? Well,
I think the main lesson for everybody is that things come back to normal.
Right.
And it takes, that was a pretty traumatic couple of years, right? And even with that level of event, 12 months later, we're right about at the 3-year anniversary right now, right? We're a 35-month anniversary right now. And I think it's safe to say that from my lens, the significant majority of behaviors have come mostly back to what they were today. Are there categories that are permanently changed? Sure. I'm going to have my groceries delivered the rest of my life, right? Once a week, we have grocery deliveries, on Mondays in my house. That's never going to change again, I don't think, right? But most of my other behaviors, not all, but most of my other behaviors have come back to, some version or a pretty close version to pre-COVID. In fitness, as I said earlier, we are working out at home more than we did because we made those investments. But we're very hybrid because a lot of us crave that in-person experience, me included. I'm 95% of my workouts are back in a physical environment.
And the data you're seeing, I'm just interested, I know we're working out more at home because that not only speaks to the investment, but it also speaks to convenience. Sometimes you just want to fall off your Zoom chair and do something and get back on.
Totally.
Do we know, is it overall gone up or down if you measure it in minutes? Okay.
Overall...
across wherever you are.
Yeah, you mean overall workouts.
Yeah, overall workouts.
I do think home
average.
fitness has helped raise the number of workouts happening in total. Okay. I don't have any solid data to support that. That's more of a gut based on where I see the business of the four-wall people relative to 2019, and the number of home workouts is undoubtedly materially higher. And so I just take those two and say people must be working out more. Now there are less physical locations, so some of it is those that are survived do have a higher market share, because there are some number of closures. You referenced before kind of like we heard 25 or 30% close, and it's kind of hard. I'm with you. I don't know that it's that high. But
surely it's being backfilled now because you've got a bunch of
franchises. A lot of franchise growth. A lot of franchise growth. But even if it was 15 or 20%, that's still a lot of stores.
Yeah, it is.
And there's winners and losers.
Right.
There's a lot of bankruptcies.
Right. Oh yeah, and more to come, I would say, in the next, because now you're not going to have government dollars going in. And
it's not done.
No, I would agree. It's not done.
I agree. But at this point, probably, not entirely, but probably businesses that may have reached that fate at some point anyway.
Right.
Yeah.
100%.
Yeah.
Where do you see health playing into this? Because we're so in that, we still haven't solved it. It's kind of like we're still talking like this. Like, when does that get real? Is it when Apple does something? Like, when? What are you seeing there?
That's a great question. I don't know. I think unfortunately we're always fighting against human instincts, and the instincts of all of the bad stimuli outweighing the good for too many people is very powerful. And until the incentive system changes at the healthcare level, and that's really hard to do, right? The incentive system is like, it's really hard to penalize those that have health problems, right? That's not what I'm suggesting, to be very clear. But I do think incentives are the strongest thing, and I don't know how they change. I mean, there are people that the federal government spends how many dollars trying to figure this out, and clearly they can't figure it out. And I think it's so noteworthy that Amazon and JP Morgan and Warren Buffett that all partnered to try to come up with a new healthcare model. I think there was three really big companies. I know JP Morgan is one of them, or that's what I recall.
And here we are.
And here we are. As far as I know, that's not happening, right? That was a really exciting announcement, when I recall, and they were going to try to change the game, and there's something really hard about that game, clearly.
Right.
So I don't know when health reflects what should be the outcomes of all of this work we're doing in the fitness industry.
Or when we, I guess, formally become a part of the preventative side of it in a much more formalised way that actually reduces the big bad number at the end and draws I think it's somewhere in that, because you've got incentivisation, but you've also got disincentivisation, and it's really hard because there's judgment in that, right? And I think that's the problem.
Yeah, it's really hard.
Part of it.
No, it's really, really hard. Look, I think fitness has made the fitter, probably.
Yeah, that's right.
Right? I mean,
wearing more wearables and more connected.
Yeah, in most cases, right? We're more aware of the impact of alcohol and bad food choices and a great workout, and a lot of people, millions of people, are reacting to that. At the same time, I think, the Fitbit revolution of step counting, and I think a lot of people who fall off of that habit, even if they got onto a good habit, pretty easy to just take those things off and stop seeing the bad data. And I don't even blame them. It's who needs to see bad information all the time, right?
And in some ways, it's when you think about it, you're right. I like that statement. It's made the fit fitter, but it's created a lot of business opportunities for people that want to get the people who know they should get fit but can't, and it's taking money off them to feel good but not actually get any results. Is kind of what generally is happening. You're still not solving. It's not solving a lot of the problems, and my feel is everyone's just waiting for that, that tablet. What is it? What is the new one? Semaglutide.
Semaglutide.
They're now pushing as okay. Well, you don't need to do anything, but that still doesn't. There's still issues with that. As great as what it is,
and I think there are benefits to the industry serving, a very wide population that does see temporary benefits, even if they fall off the wagon. I mean, I think getting into a good fitness routine for 3 months or 6 months and seeing that you actually do feel better, even if something then still takes you off of it, still has some positive impact. That you remember it, maybe makes you more likely to go back to it. So look, I think the industry is still doing good things. At the end of the day, the industry can only do so much.
Absolutely.
And it is a business. And it's okay to sell your product and service to willing buyers, right? I mean,
Yeah.
there's lots of, right? I mean, there's nothing wrong with that, right? I say that truly believing that there is a real mission by many entrepreneurs and businesses to do good. They do the best they can. Yeah.
So I've got a final question.
Yeah.
What are things that you're keeping your eye on, like without saying any confidential information about companies you're looking? But
Or
are you?
feel free to offer that as well.
Are there any things
Let
that
me take my
you're sort
dialogue
of that you're sort of, gravity of ideas that you're saying, okay, this is something to be thinking about and keeping an eye on that looks like there could be some potential there? Is there any things that?
Within, I think, the sort of core fitness market, I'm going to give you a very disappointing answer,
Oh, okay.
which is
Thank
no.
you for managing our expectations.
I think we're still working our way through what was a very traumatic 3 years. And there's still recovery going on. Look, I guess I would say, I think people are craving the customized one-on-one advice, and whether that's willingness to pay a personal trainer or willingness to subscribe to sort of modified personal training, right? Meaning, they give you the plan and you follow it and there's some amount of accountability. I do think that the idea of like, this was customized for me is still very powerful and has a long positive way to go, aided by technology and advances in technology. And so I'm not specifically necessarily looking into that. Will ChatGPT tell me how to work out, every day, give me a workout plan? Maybe. Maybe if I tell it enough about me, it'll be able to spit that back out. I mean, I think we're a long ways away from having credibility in AI like that. I think there is still a very human nature to it. But people say, oh, the industry hasn't evolved, that much. I think that's not true, right? Boutique fitness is still a relatively young concept that has taught a lot of people how to work out fundamentally differently and smarter and harder than they used to. Planet Fitness invented a completely new pricing model that the industry's never seen before. And I believe the data is, forever, Ursa said 17 or 18% of Americans were members of gyms. That stat was flat as can be. It got over 20 before the pandemic. I don't know where it is today. And that is, in my opinion, 100% a result of pricing innovation and making it more affordable for more people. Peloton brought tremendous innovation. And so, there is meaningful innovation that's happened across 3 different parts of the industry.
What makes that, just to pause on that for a final, what do you think makes the Planet as a night, like now purely from a business perspective, like Planet, as you said, that moved the needle, changed the price. Okay, there was obviously a real detailed explanation about how they did that. Peloton, they if you analyze that, there's some specific things that they did to capture such a big thing.
Yep.
So what do you, when you drill down it with smart brains like yourself, how do you look at that and say, okay, well, here's some of the things that go into that recipe to move the market on such a big way? Or is that your sort of like holy grail of what
No,
you're
it's not a holy grail. No, not at all. I mean, I think, so you summarized, Planet did 2 things, right? It was a pricing innovation, and it was a very conscious effort to create a comfortable, no intimidation, no judgment environment.
No dropping the weights, no screaming, no yelling.
Yeah, exactly. That no lunk thing was kind of cheesy, but it was brilliant, right? I mean, and so they did 2 things really, really well, right? And that brought that consumer in at a much higher percentage. Obviously, I think everyone knows what Peloton did well. I think in general, it's creating a product or services to meet an unmet need. And so what has boutique fitness done? It's the unmet need is like, I think, is creating an environment to get people to work out a lot harder, right? Those classes, personally, and I think there's a lot of people like me, I get a fundamentally different workout when I take a class versus just going to the gym floor.
Yeah.
I mean, I really do. I'm not
Yeah.
alone in that. It's truly immersive, and it's motivating. The other thing I find it to be is meditative, right? For me, my phone's in my locker. I wish everyone would do the same thing, because I don't think people need to text in between, moments of breaks in boutique fitness. I don't get it. But like putting my phone away and being told what to do for 50 minutes, I make like 1,000 decisions a day, don't we all?
Yeah.
It's the greatest. I have no decisions to make for that whole hour.
Yeah.
I love that.
Yeah.
And so it's meeting a consumer need. And that's what great entrepreneurs figure out is like, what is the opportunity? What is the consumer not getting? How do I give it to them in a way that is valuable, right? Maybe it's really expensive but valuable. Maybe it's really cheap but valuable. But where there's a consumer perception of value.
And then I think on those two examples, you'd have to throw in their marketing grunt. I mean, like sheer dollars, like
Yes.
spent through Peloton, through Planet, just because of the size. And I don't know what your view was, but I loved both the marketing campaigns this year of Equinox.
Yes.
We Don't Speak January. For the first time, you didn't have some naked hot guy.
Yeah.
It wasn't all about that. It was about it's a lifestyle, not
Yeah.
just one day. I love that. And then I love Planet, low E. I think the whole do a workout because you will feel better.
Yeah.
You'll feel the energy. And to me, that's changing the narrative. And that was really powerful through marketing.
Through marketing.
If you had this
Yeah.
this thing and you didn't tell anyone about it,
No question.
Yep.
But remember, those things started with low marketing budgets,
yes,
right?
yes,
Equinox once had one gym, then it had
Yes.
3, and then it, and Planet had 1, right? And so that pricing innovation came first. They were able to figure out how to bring the consumer in and get the word out. Now, obviously, when you have 2,000 locations, you have the scale and the ability to shout it from the rooftops, and they've done, in my opinion, quite a good job.
Yep.
Yeah, quite a good job. And so yes, marketing is critical to making something big. Making something big.
Well, thanks for that.
Yeah.
this has
That's
been
a
amazing.
lot to think about. I like the way you sort of look at things slightly differently, but in some cases very business basics, isn't it?
Basics.
Which we kind of forget.
Yeah.
I suppose.
Well, we got ourselves confused with the technology industry. Like we're consumer
It's not the
people.
first time though. Like remember
No.
the tech boom. We kind
Yeah.
of this has happened before, hasn't it? I suppose, and we've all got short memories.
Well, right. The low interest rates combined with the stimulus combined with COVID created just a very unusual.
We had a lot of crazy people.
Yeah, created a lot of crazy people.
And being locked inside for 28 months, I suppose.
It was
it's
hard.
excusable.
It was.
But we're still here.
We're so
We're
happy
still
to be here, aren't
We're
we?
happy to be here.
Yeah.
Excellent.
Life
Well,
is
thank you.
good.
Appreciate your time.
Absolutely.
Thank you for listening to this episode. If you've got any value from it whatsoever, then please do us a favor, like, subscribe, tell somebody, and that will help us to be able to continue to do more of these and help you escape your own personal limits. Thanks for listening.